Awesome.
Hello everybody. Thank you for joining us today for Fordham Private Equity Venture Capital Club's event, which is the Fireside Chat with Pave Finance's co-founders, Peter and Pascal Corey. So it's such a pleasure to have you guys with us today. You guys have um, incredible history and experience both in the hedge fund world and in McKinsey and consulting, and we are just so gracious and grateful to have you guys with us today. And I also have my lovely co-host, Anshul Agarwal, who is a junior board member with us at Private Equity and Venture Capital Club. So really thank you guys for joining us, and we're just so excited to get the event started today and really discuss all your lengthy experience in the hedge fund world and in investments and in the startup world. So I will, sorry, let me just move this to speaker view. Awesome. So I will introduce Peter Corey. Peter is Pave's co-founder and CIO. He's worked in finance for almost 40 years, including running trading desks for major Wall Street banks, working as the SAC's first macro strategist, portfolio manager, and consulting for some of the biggest investors in the world. His biggest accomplishment, however, was starting his own hedge fund, Timescape, which was a top 10 performing hedge fund for 10 straight quarters, during which they outperformed the S&P by over 70%. He graduated with both a BS and MBA from Wharton. And the CEO is none other than Pascal Corey. He has spent time in McKinsey's New York office as a business analyst, where he worked on numerous strategic and operational projects, including launching digital projects, managing marketing and sales teams. And prior to McKinsey, he spent time as a product manager for both startups and large corporations in Silicon Valley. He graduated from Stanford with the BS in digital product design and self-designed major combining human-computer interaction with design theory. So they are incredibly well-versed and good at what they do, and we are just so excited to really learn from them today. So we are so excited. If everyone can give an round of applause. And yeah, so let's definitely get started. Anshul, why don't you start with the first question and introduce yourself as well?
So, I'm part of the MBA program as well, and I'm in my first year. I'm doing my concentration in finance, and to know about Pave, and I think it was really interesting that you've developed this app, and I'm happy that you guys are here spending time with us. My first question would be, what is Pave's investment strategy, and does it change depending on an individual's risk appetite?
Sure. So I just want to quickly take a step back, and for those of you who don't know, explain what Pave is. So Pave Finance is, it's effectively an active investment management tool. And from a user experience perspective, what that means is you basically download the app, sign up, connect your bank account, choose how much you want to invest. And then Peter and I have developed a series of algorithms that effectively actively trade for you and invest for you. Across all four major asset classes, going long and short. So the algorithms can make you money no matter how the market is moving, and is constantly optimized for a series of economic and market circumstances. So to quickly answer the question of does it change based on users' risk profile? As of right now, not yet. We just have kind of our main fund, which due to the fact that it's actively managed, is kind of built to produce optimal returns, and we just feel that that's kind of best to have everybody invested in the same kind of fund that's optimized for returns. But as we continue to grow, I'm sure we'll diversify fund offerings and offer kind of some different funds with different risk profiles. But Peter, if you want to speak any more to that.
Yeah, essentially it acts like, it's supposed to mirror a hedge fund that I would start for fund of funds, institutional investors, but it's for people that could put in as little as $10. So if an investor, when I was running my old fund, and if I were to start one now institutionally, it's one program. So it's going to mirror that. And some hedge funds have multiple strategies. This actually does mimic a multi-strat macro fund in the sense that it's going long and short equities, fixed income. It mirrors trades in currencies as well, and commodities, and I also do some things with volatility. So it was just born of the fact that the last hedge fund I had it was very fulfilling for me because we ended up having all the employees in Pakistan, including my partner was there before he moved back to New York. And it gave me a sense, after being in a very entitled industry for so long, seeing some people with a lot of excesses, not feeling very fulfilled, actually, despite the amount of money some of these guys were making. I wanted to do something that with Pascal that would be long lasting, and also work on some kind of, if I can say, a social good. It's very difficult in a hedge fund vehicle to do something for the social good except making the wealthier wealthier. And I really didn't want to do my part to help it widen what's already something that's already too exaggerated to begin with, and needs to kind of come back. Yeah, and the one thing, I mean, just to add to that, is the one thing I forgot to mention about, what is Pave, is it's zero minimum and zero period. So anybody invest even $5 and pull it out within a matter of business days if they need to for any reason. So we really are trying to build something that people historically haven't had access to, and give everyone access to it.
So thank you for that description, kind of insight into why your team even started Pave. So the investment strategy, the risk appetite, all that's really interesting. So now that we kind of have an insight into the fact that you guys are working with the average consumer that might not have the access that most other people do, what is the investment strategy and risk appetite of the average consumer, the person that isn't smart money per se, as you guys kind of discussed in your podcast? And now we kind of have an understanding as to why you started Pave Finance, but we want to know how that kind of funnels into the investment strategy that you guys have.
Yeah, I can speak to the consumer aspect, and then I think, Peter, you're definitely better suited to talk to the investment strategy and risk specifically. But yeah, so I think, the average consumer, at least the ones that we've talked to, and also myself, when I was as I mentioned, I was working at McKinsey in New York before starting Pave, and I was, fortunate enough to be making enough money to be saving some. And I was kind of, looking at different investment options and wasn't really super excited about what was available, right? Like, either I had to kind of take it into my own hands, open a brokerage account, like through Robinhood or TD Ameritrade or something like that, or E-Trade, place my own trades, things like that. Or I, had mutual fund and robo-advisor offerings like Wealthfront, Betterment, things of that sort. And, the brokerage firm, active personal, like I had to, physically go place the trades thing, wasn't super exciting. Cause I was working 70 to 80 hours a week. I was pretty exhausted. I didn't want to have to take more time to figure all this stuff out. I didn't feel like I had enough time. And then, the passive options, which are the mutual funds, I just wasn't very excited by the risk profile, or by the return profile rather. And I was really frustrated by the fact that, especially right now, given that bond yields are so low due to the fact that interest rates are really low, mutual funds returns are largely driven by stock performance. And so, you're kind of just at the whims of the stock market. When it goes up, you make money. When it goes down, you lose money, but there's nothing you can really do about it. And that was really frustrating for me. So that's something that I think is very exciting to both me and then the people that I've spoken to about Pave, is kind of the ability to invest in something that can offer much more attractive returns than a passive investment manager, which is historically what's been available to the public. And also take advantage of all kinds of different moves in the market so that you're protected on the downside and even making money on the downside, which other companies available to the public just can't offer. But that's what I would say about kind of what the consumer is looking for, and the niche that we're trying to fill. And then, I'll pass it off to Peter to talk about how we're doing that.
Right. I don't know, have you had any presentations by hedge funds before? Are you familiar with all the different strategies that are available? Or I can give like a quick overview of the industry.
We have, but none as quite as experienced as yourself. So I know that whatever you say will just be profoundly unique.
Well, the bulk of, across all the hedge fund offerings, when I started, there were about 10,000 hedge funds. I think it went down to about 6,000 in 2008. And I think it's probably back up. So the bulk of hedge funds are what's called equity long short funds. So they're investing in individual equities, they're going long and short. Now the basic platforms are, Steve Cohen's Point72, you got Citadel, you got Millennium. They've kind of aggregated a good part of the industry and concentrated it. and they're all, like the individual portfolio managers are limited to being market neutral for the most part. And then what happens at the management level is they're levered 5 to 8 times from there. So when you're seeing returns, what normally happens is, like, a smaller hedge fund would be, they tend to be net long 40 to 50%. So essentially they're like a long only offering. And because, based off what's happened with passive investing, it was very difficult for these types of funds to kind of make anything close to even a risk adjusted equal return to the, just the buy and hold strategy for the indices. You're seeing some correlations break down, so that this year's been very good. The past year's been very good for hedge funds, equity long short hedge funds. There are credit funds kind of doing the same thing, with their individual companies, and then what they'll do is they'll trade off different credit spreads in terms of, like, maybe they'll go long junk bonds versus short investment grade. They might do plays in terms of maturity strategies as well. There are special situations, hedge funds, and then there's the macro. And all of these can be either systematic or discretionary. And when I got to SAC, that Steve was pretty much the driving force behind the fund. And as he grew, he became increasingly a smaller part of the actual return stream, which is, in a sense, if you look at SAC's returns over time, they're nowhere near as good as what they used to be, because it was mostly Steve who's the best trader I've ever seen, like, bar none. I've seen a lot of really good traders. But for what I do in terms of macro, a lot of macro traders are looking at all macro traders from a discretionary standpoint are looking at the world from a very large perspective overall, trying to figure out, okay, what's better? Do I want to be long stocks versus bonds? Do I want to be long the dollar or short the dollar? Do I want to be long or short commodities? And within the commodities, like lately, you've seen more of the cyclical commodities, such as the metals, copper, crude, outperform gold and silver. So there are different plays that you can actually be positive stocks, but depending on what sectors, you can go long Australia and China, go short Eastern Europe, that type of thing. There's a myriad of combinations that you can have. So what I found is that the market will reward you for having the right exposures in the right risk parameters. So there are flows that trade off of inflation versus growth. That there are something called scenario analysis, where you can look at, you can quantify it in different ways. You can look at credit spreads, or you can look at, like JP Morgan has a global PMI index for manufacturing, and you can look at these inputs and say, okay, I'm using this as a proxy for business conditions getting better. And then, for inflation, the classic instance, if you look up, like, on Ray Dalio's website, talks about this. I mean, I learned about this as an undergraduate in the late 70s, actually. It's been around for a long time. But people tend to trade off GDP and CPI. But GDP comes out quarterly, it's revised, and CPI comes out monthly. What my bias is, and what I would advise for anybody who wants to kind of look at, not take what is, a CNBC or a Bloomberg television view of the world. Yeah, exactly. Look at the data. And what's great is now is you have incredibly deep markets in instruments that trade every day. That gives you a real-time price as to what the market actually feels is the actual direction of inflation and growth. So I would look at, there are 2 ETFs that you can look at. One is David Boy Charlie, Deutsche Bank Commodities, DBC. That's an ETF, and also GSG for Goldman Sachs commodities as well as GSCI index. And you can look at it every day and see, just look at the trends of it. And it'll give you a sense as to whether or not the market is looking at people to have, whether or not they have pricing power. Lately, that's obviously been the case, and you've also seen credit spreads coming in. You've seen global PMI going up. The question is, and my models try to catch this, is when are there inflection points? You know, very often people like Soros used to just have a view that on the market and would put billions of dollars at risk without a lot of risk parameters. Stan Druckenmiller does the same thing. He's brilliant at it. But they get a view of the world and they say, okay, my view is better than the consensus, so I'm going to position myself in this particular way. In fact, if you can look it up, I think Stan has a 1 hour long, in fact, maybe I can give it to you, give you the link.
Yeah,
maybe
sure.
I can look at it. He has a 1 hour interview with Goldman Sachs where he talks about his market outlook. And it's pretty much consensus. I mean, he's short the dollar, he's long commodities, long equities, and short bonds. So the whole issue is all of these capital flows coalesce, and you've got to try to figure out when the market is overly discounted something. Like at this point, the market is certainly at an extreme position of optimism. It's a liquidity-driven market, so can we get to the same excesses that we saw in 2000? And I say yes, definitely. So the market could go higher from here, but the risk return is not great. And typically, when you get to this point, like in 2000, if you just were to invest in stocks now and hold for 10 years, you'll make no money. Typically, when that happens, when you're in a deflationary environment, which we've been in arguably since, you can say since actually for the past 40 years, with some exceptions, brief exceptions. When you have that, you have stocks and bonds going up together, so you can use long bonds as a hedge. The problem is now there are two problems with that. One is inflation should be picking up. There's some arguments, strong arguments for it. There's also some arguments against it. But in an inflationary environment, stocks and bonds move in opposite directions. And they move together. So since the 80s, what people have done is like Ray Dalio, they put up something called risk parity, which has been a very successful strategy. You look at the risk or the volatility in bonds, and you increase the position in bonds to have the same risk profile as a stock portfolio. And so you try to equalize the risk involved, and then you invest in both. And normally it's a hedge. When stocks go down, bonds tend to go up. But in an inflationary environment, they move off inflation expectations. And that means they both move up and down together. So what I'm fearful of for people who are just entering, you know, the savings world right now, and people that have savings in the markets right now, are operating off a different paradigm, the wrong paradigm, the paradigm that's been in existence for the past 40 years. So we want to start something that has an alternative for people that don't have $1 million in liquid cash they could put into a fund of funds.
Aren't many of those.
Yeah. And offer something that will be able to create positive returns over the next 10 years. Because I really am fearful that, you know, I mean, obviously, if you're continue to enter into the market and buy dips and things of that sort, you'll end up okay. But the risk return at this point is horrible. And it's also horrible in bonds as well. And it will be, so that you have asymmetric risk in the two biggest asset classes that everybody invests in.
Yeah.
So we want to offer something that can also go long and short, but also offer exposure to cyclical ETFs, like the EWZ is a Brazilian ETF, EEM is the emerging market ETF, and my models can go long and short that as well as IWM, which is small cap Russell index, and as well as the NASDAQ and the S&P, which are obviously the large caps and techs. And in addition, have the ability to have people get exposure to crude oil, to gold, silver, natural gas, that type of thing. So and it's not going to be levered. Most hedge funds need to trade leverage, and that's where you tend to get explosions. Yeah. Most hedge funds position themselves based off volatility. So as volatility goes lower, they increase their positions. The problem is volatility is reverting. So you had problems, let's say in 2018, in both January 2018, the end of fourth quarter 2018, something that you might have seen in March of last year, which is a little bit volatile. All of these periods were preceded by very low volatility periods where all these hedge funds, and there are also volatility-based index funds that leverage themselves, because at that point, volatility is so low, they need to lever themselves up at the wrong time.
Yeah.
So we want to try to avoid that and actually take advantage of it as well. So we have models that will be able to use that as a risk parameter. And in fact, right now, the volatility is extremely low. And the one last thing I'll say is we use insider activity very, very carefully. That's something that I'd advise everyone to look at if they're looking at a particular stock. You can try to find out if there's been insider selling, and not. The problem with that is look for the CFO selling. Like a CEO buying is not going to say anything. It's all window dressing. But if the chief financial officer, chief operating officer, chief accounting officer, or marketing officer, if you start seeing them sell, and also like in clusters, that's a real problem. And like, for instance, GameStop, which has been obviously in the news, hasn't seen a lot of insider selling, which is interesting. To me, I'm kind of in the same Wall Street consensus that
it doesn't make any sense.
Yeah, but the fact that there's no selling in this thing, it would keep me out of shorting the stock. So that's something that we rely on quite a bit, even though we're not trading individual stocks. And just as an aside, insider selling right now is about as high as it's been over the past 5 years. So insiders are not buying into this whole reopening thesis. So anyway, long-winded answer.
Well, that was good. It was comprehensive.
Yeah.
So that was all the information we needed. And I know Anshul is just dying to ask this question. We're going to skip ahead a little bit. So I'll
Sure.
give it away to Anshul.
I think something very relevant to what you just spoke was also discussed in your podcast, where you mentioned about market mania and we being on the market top at the moment. And as you rightly said, the risk reward ratio isn't as favorable as it was earlier. So how does one invest in such market cycles where prices and valuation seems too high?
No, I think that's probably a better answer.
Well, there are two ways to think about it. I mean, will the markets be higher 5 years from now than they are right now? Yes. So, and you have the power of compounding with you right now. I mean, I don't know if you've seen any of these studies, but if you put in $50 a month for the first 10 years of your adult life and get to a certain level, you're much better off without stopping then than if someone doesn't do anything until they're 30 and starts doing the same thing for the rest of their life.
Yeah, if I could throw in one little fun fact. So the standard person, right, like retires at 60 and they start investing, we'll call it, around 20 years old when they graduate college. Generally, the first 10 years that you've saved, assuming that you save the amount, like the same amount monthly, if you've saved the amount of money that you've saved from 20 to 30, by the time that you're 60 is actually worth just as much as all of the money that you've saved from 30 to 60, because you have that additional, up to 39 years of savings that are the time for the returns to compound. So Peter's point is it's incredibly imperative to start early, because the earlier you can start investing or saving, and the longer that money can be exposed to positive returns, it's going to have very outsized results. But yeah.
But given now that we're at kind of a precarious position, what I'd recommend is to focus a little bit more on emerging markets, because Asia, especially, because they've done a much better job. The debt overhang that we're taking on now. Everyone's so excited about the $1.9 trillion in stimulus payments, but they're non-productive. Normally, I'm not a big fan of Larry Summers, but he's got it right this time.
And who is Larry Summers?
He was to be the Treasury Secretary. He was the president of Harvard, and but I tend not to agree with a lot of the things that he says. But he's advocating right now that it makes no sense. We've gone a little bit too far in terms of it was necessary. Obviously, I'm a big advocate, obviously, for making sure that there's a social net. But there's a lot to that package. $180 billion is going to private schools, and you can take down the whole list. So Asia's done a much better job of avoiding debt. You can say China has a lot of debt from the state and local level that's not shown from the federal level, and they are highly levered, but they're growing fast. Yeah. So I would definitely move a little bit more toward Asian exposure, Asian ETFs, and
value stocks in the U.S. too. Right?
Certainly, value stocks now is the big thing, no question. Like banks, any kind of cyclicals. So that's why it's very important for everyone to kind of look at interest rates. And if you can't, just look up, if you don't have access to the 30-year Actually, the 10-year yield is probably the best thing to look at. And if you can look at the Barclays, they have, I'll try to send a link to how you can track some of these things. I don't really need to go into that, so you don't have to worry about the details of it right now.
Yeah, we'll send some links in a follow-up email.
Yeah. But if we do get a flush over the next, I'm actually wouldn't be surprised if we get, we can go one of two ways in this mania. Either we're, it's liquidity driven move, and we're going to go to possibly 6,000, like another 50% higher in the S&P over the next year. It's possible. I can't rule it out. My base case is, and again, I'm saying this after 40 years of experience of knowing that when I'm sure of something, it never, usually the system is so complicated that other things enter in that move things around. That's why I'm a big advocate of using quantitative systems and technical systems as opposed to just going on a viewpoint. But what I would say is enter into some trades. When you enter into a trade, figure out how much you're willing to lose on that trade. And if it's too much, just reduce your size. But think about buying something for the long run. You want to be diversified. You want to have exposure to Asia, no question. I try to keep the trades somewhat smaller right now at this point. And then if you start to see panic in the market, in the media, kind of like what we saw in March of last year, that put more money in at that point, that type of thing. But look at crude oil. That's a very good indicator as to global growth. If it starts coming off, starts falling, be a little bit more cautious. And there are always things, if there are ways to shift into, let's say, dividend-paying stocks, things like that. So there's some ways to kind of mitigate the risk. The great thing is right now you have a host of ETFs to trade from that you can kind of get a view, and you don't need to get any advice. You don't need to go you do your own work, and you can pretty much put your own portfolio together. There's really no need to pay mutual fund fees when you have these types of instruments available to you. Like ARKK right now, I'm sure you've all heard of it with
Kathy Woods.
Kathy Woods, yeah. She's it's a very sexy portfolio. It's a very dangerous portfolio.
You're talking about the innovation one, right?
Yeah. But I'm saying that if you start so if rates start going up, you see the 10-year above 2%, get very concerned about tech stocks at that point. And also being in bonds. But it's kind of a constant thing. It's that's one of the reasons why we're starting it. It's very difficult to kind of just do this if you're in a career
you don't have 40 hours a week to do it.
More like 100 for me.
Yeah, well, that's true.
So I'm waiting to this. So but just for general parameters, look at the direction of crude. Look at the direction of those two ETFs I told you about, GSG and DBC. Look at your sense as to whether the market thinks we're in an expansionary period or not. Take a look at the JP Morgan PMI index, and things of that sort, to decide where you want to be. And avoid bonds for now. Certainly avoid bonds for now.
Thank you so much for that answer. I know that a lot of our viewers will be taking that advice with stride. I know I will. And I want to kind of expand on what you said about the deep data models that you guys have. So you do have other competitors like Acorn, and they do have big investors behind them like BlackRock, PayPal, Dwayne Johnson, Ashton Kutcher. We want to know what's going on in your data models that's allowing you guys to perform better than your competitors, and what really sets you guys apart.
Sure. Well, just to start with kind of Acorns, right? I mean, Acorn's an awesome company for sure. Like, definitely don't want to say anything to slander them, because I mean, what they've done for savings and making savings accessible to everybody is incredible, right? But they're not really an investment tool. Like, they do have a mutual fund basically that kind of runs on the money that you have saved. So you do get exposure if you choose to invest the money that Acorns is saving for you. But I mean, I wouldn't call it the most sophisticated kind of investment system. Obviously, their big kind of driving factor in how they make money now is just general banking products, right? I believe they have coming out with a credit card. They're trying to push that very heavily. They probably are going to start moving into into loans, things of that sort as well, and just kind of more broad banking. So that's, Acorns. I would say we are more closely kind of competing with a company called, I don't know if any of you are familiar with Titan. So Titan is kind of right now the only active kind of investment tool on the market. And the reason why I put active in air quotes is it is active, but it's really just based on kind of their CEO or CIO rather, and kind of a team of analysts, which I believe right now is just one, making kind of stock decisions. And they're pretty much a equity long only strategy. They basically just have a portfolio of 20 kind of large cap stocks. That's their flagship fund. They also have an opportunities fund, but that's a lot smaller. So I'll talk about the flagship fund for them. And their return profile, tracks very closely to the NASDAQ. So same kind of situation as a mutual fund, right? Where when the stock goes up, their stock market goes up, they do really well. When the stock market goes down, they don't. They obviously have much larger swings on either side of things because they're investing purely in equities, whereas mutual funds will be a little bit more diversified across asset classes. But in either way, kind of there's no ability to really make money when the stock market's going down, and there's no way to really temper your risk on the downside. So where kind of to that question specifically in terms of like what differentiates us from a technical models perspective is, and I'll obviously let Peter go into some of the high level details, but is that the models that Peter has built are really, really good at timing the market. And as he mentioned, identifying inflection points. So for example, right, like this year, we're up like 9-ish? 9. Yeah, I call it 9-ish% year to date. And the S&P is up, what, 4? Yes. 4. So, it's basically as a result of being able to kind of take advantage of ups and downs in the market, we can pretty consistently outperform what's typically available to the public. But yeah, I'll hand it off to you for kind of, high levels of like what the models are doing.
Right. I mean, I started out becoming, I was trained kind of as an econometrician in school, and I did a lot of speculative markets work and options theory. But I was always a fundamentalist until I got to SAC. Well, actually, I traded prop for the last 3 years when I was on the sell side. So I started to do a little bit of technical work there, but I really got involved with it when I saw how Steve traded, and he really gets inside the price action. And over the years, I built the models so that right now there are 4 modules to it. The first one is what I'd say is a fairly sophisticated filtering system that gives you the underlying trend, but it also tells you historically when things have gotten stretched, when they've gotten into the tails of the distributions. So when that happens, I'm looking for the possibility to take profit, and then I'm waiting for the trend to turn to reverse positions. Within that, there's or side next to that, there are price patterns that exist in bull markets and bear markets that have been fairly robust over the past 100 years. And so I'm looking at relationships on the price patterns with each market that we trade. And then I'm a big advocate for cyclicality as well. So I'm looking at cycle patterns as well, timing patterns, when it's almost like an actuarial table, when a rally is kind of due to kind of fizzle out. And then based off capital flows, I'm using an econometric model that doesn't look at economic inputs, but economically sensitive assets to kind of, which have a very good forecasting record of looking at what happens, let's say, between bonds and crude, or the IWM and gold, the Russell and gold, things of that sort, that will predict future capital flows that move markets. So when all of these things kind of fit together, I'll get a model signal that triggers, and I'll go long or short. I'm not always, like very often, like right now, like in stocks, my models are still long, but they're saying things are kind of are really stretched at this point. So for a few models, I'm not long or short, I'm flat. So it organically moves, and it's not rigid in the sense that I'm stuck, or we're stuck to trading growth stocks or large cap or small cap. The model itself tells us, based off the capital flows, we can be long. Like the Russell's had a huge move up since the election, and it's been long, the Russell, and as interest rates have gone up, it's gotten short bonds as well as short the tech stocks. And as capital flows start to, and investors start to discount a different scenario, it organically repositions the portfolio.
So it sounds like the data models that you guys have are really, really sophisticated. Not only that, they are backed by Peter's experience and his understanding of the markets, as well as the deep, deep learning. So that's quite unique. I know that Anshul is really, really curious about your background, Peter, and we just want to dive into who you guys are beyond the numbers and beyond the markets. We just want to know a little bit more about you guys as well. So I know Anshul's dying to ask this question.
Yeah, absolutely. Because Peter, you mentioned that finance was not your first career option. And so how did you eventually build a career in finance? And something, we've got so many students with us. So what advice would you give us to build a career in finance?
I'm sorry, can you repeat the last part of the question?
So I was saying we also have a lot of students today. So what kind of advice would you give them to build a career in finance? How do they go about it?
Well, specifically, I just focus on my grad school experience, because you tend to get pulled into whatever's trendy. Like, so everybody at Wharton at the time wanted to be an investment banker. I mean, there are a couple of consultants, but not a lot. Everybody was like Goldman, first Boston, which is now Credit Suisse.
Hasn't really changed.
So I actually set up, it was a different period back then. I only sent out 3 resumes to 3 investment banks.
And that has changed.
Yeah. To Goldman, Lehman, and something called Drexel, which is no longer around. And I just happened to be in New York. A friend of mine was working for Lehman Brothers, and he walked me through the trading floor, and I fell in love. I actually called the firms up and I said, I don't want to be an investment banker. I want to interview for trading. And Drexel said no, so I still went through an interview in investment banking that I hated. But I ended up getting offers at Goldman and Lehman, and I ended up going to Lehman. What I would say is, everyone gets influenced by their friends, and just try to know yourself. And if you can talk to people in the industry, that if I had talked to someone who was in trading, I would have automatically known that's what I was, that's what excited me. So, I don't know what kind of resources you have. I mean, it was kind of like a conveyor belt at Wharton. You just kind of go to the career office and you put your name on for interviews, and you just kind of pick and choose kind of a thing. But actually, you're great with networking, so I'd probably defer to Pascal on that. But I don't think things have gotten a lot more institutional as well in banking versus in trading versus when I was there starting out. A lot of the hedge funds now are kind of the more independent groups. So if there's some way that you can, if you want to get into finance, I would maybe look into some of the hedge funds as well, based off whether you like bonds versus stocks or credit analysis, that type of thing. The general advice I would give you, though, is when you're in an interview, the person interviewing you, there are cultural differences at all these firms, and you want to try to please everybody during an interview, but you're also interviewing them as well. So try to get it. Just in the back of your mind as you're answering their questions, try to get a sense for who the person is that you're talking to and whether you'd like to work with them or not.
Yeah, I can't emphasize that point enough. I feel like that was a huge kind of mindset shift for me when I was interviewing, all over the place, was because I was also out of college, was interviewing both with product management, so tech companies. Basically, I was interviewing at large tech companies with associate product manager programs, and as well as large consulting firms. And it really does kind of give you the right perspective and kind of attitude and level of confidence, I think, when you walk into a room and think not only obviously I feel well prepared and I'm ready, and the preparation part is huge, right? Because that allows you to feel like no matter what, you did your best, right? So if you walk in well prepared, knowing that not only are you trying to just put your best foot forward and let that preparation shine through, but also just like really be attentive in the moment and try to pick up on, exactly as Peter said, right, the person who's interviewing you, what they're personally like, the way that they talk about their company, things of that sort. And just the way that the interview is conducted in general, you know, like that was a huge part of what made, because I was choosing between McKinsey, Bain, and BCG on the consulting side. And the interview process, and frankly, just like the kind of questions that I was asked and how the interview process was kind of conducted, that was a big part in what eventually made my decision to choose McKinsey. So having the chance to, like, I think step one is obviously like, yeah, as Peter said, talk to as many people as you possibly can to, like, one, understand the industry itself and understand the role, and understand if you'd even like to do it, right? That's the first step. But then also, if you realize you would like to do it, how does the interview typically go? How are the ways that you should prepare? What are the steps that you should kind of go through to make sure that you're walking in as best set up for success as you possibly can? And then once you've done everything that you can do, know that you've done everything that you can do, be confident in what you've done, and just kind of, you know, be present in the moment, and kind of just like let things come to you a little bit as well, right? Because I feel like when people are so eager to please, they get so stressed, and then they stop thinking, and, you know, that's when disaster strikes, in an interview scenario or just like in any scenario. So, you know, obviously, you know, you'll be stressed to a degree, right? Because I definitely was, right? But like, it came in the form of adrenaline, which I think was a little bit more of a mind boost rather than a mind numbing situation. So that's what I would say, is yeah, network as much as you can, prepare as much as you can in the right ways, you know, work smart, not just work hard. And then when it actually comes to the interview, understand that you're there to learn about them as well, because that really makes you listen. And I think just contributes to a much better conversation and performance, if you want to call it that way, in an interview. But you can continue with what you were saying. Sorry.
And I had kind of a special or exceptional experience in the sense that when I got in, there were 42 MBAs for the Lehman program for the first part of the program. I was there in June. It was a July program with as many, and now there are probably hundreds, for Goldman and the like.
Yeah.
But I got pulled out because I knew how to program option models, and they needed to. It was kind of like right place, right time. And I was building a group when I was 23. I mean, the downside of that is I had no mentor. So now that things have become so, there's such huge organizations. What I would say is find once you're there, find somebody that you really could see yourself, what you would love to be in 5 years.
Yeah.
You know, whether, you know, and of course, and assuming that you like the culture.
Right.
That's the biggest thing. If not,
if you can't find someone you want to be in 5 years, it's a good sign that you shouldn't be there. And to be fully transparent, that was a big reason why I chose to leave McKinsey. But that's more a me thing, not a McKinsey thing. But anyway, back to you.
Yeah. No, and then try and be genuine. I mean, so many people try to make the appearance of working hard or putting in the hours. Just focus on the fact that where do you want to be in 10 years or 5 years? What you want to be is you want to have knowledge, and you really have to build human capital. And the way you do that is not posturing or just sitting to the point where you're exhausted just to kind of be seen that you're there on the weekends or whatever. So really try to figure out, okay, how mimic, you know, if this, you know, if finance is your thing, and you know you're in investment banking or you get a job as an analyst, you know, or in trading. Or sales, find the most successful person that you like. I mean, there's a ton of successful people in every field, and just mimic what they do. And you know, what are they reading? What are they looking at? You know, what is important? The biggest thing that I found, in fact, you know, after I closed the hedge fund, I've been waiting for the right time to set up a macro hedge fund, and it hasn't been around because the prices weren't there. Everything was artificial. Now is the right time, which is why we're launching Pave. But for 10 years, I was consulting. And the reason why people were hiring me is what I looked for is, okay, there's a myriad of things to look at, you know, at any one time. What's going to drive the market? What are the 3 things right now that are most important to focus on? So try to figure out like who kind of does their job really well.
Yeah.
And stick with them.
Yeah.
Literally.
And then the better you get, you can put your own spin on it, right? I mean, when you're just learning out and you have no idea what you're doing, which, you know, most of us do when we start a new job, or I'll speak for myself personally, I had absolutely no idea what I was doing when I started at McKinsey. And then you find people that do the job really well. You just kind of start doing and learning that way. And then once you're kind of well-versed enough in kind of what has been done before, then you can actually start critically thinking about, okay, well, what are the better ways to do this? Like, are there ways that suit my skill set better? Or things that, like, I don't know why they're doing it that way, I'm going to do it this way. And then sometimes you'll find out why they did it that way. But other times you'll just realize that, you know, the other way works better for you. So it's good to like build that kind of foundational skill set by doing exactly what Peter mentioned, which is kind of mimic people who you've been very impressed by. And then once you've reached a certain level of proficiency where you're not having to think about all the steps that you're going through and can just kind of act, and then you can kind of get to that higher level of thinking where you're starting to basically do a meta-analysis on your workflow and understand, you know, what are the pieces that actually have been, you know, producing a ton of value for you, and what are the things that haven't been so much, and then how can you do more of the things that obviously help and less of the things that don't. And one other thing that I just want to quickly mention, which is, I mean, Peter already said it, but I just want to emphasize it, which is, yeah, I mean, which is the thing that he said is you don't really, you know, have success in your career by just posturing. You have to actually put in, you know, the real work and learn things. And I agree. Obviously, there's at any kind of entry level position at a consulting firm, bank, whatever, there's going to be a degree of posturing that's just frankly necessary. Like, and that's just the political nature of a large organization. But the thing that you want to try and do as much as possible is cut through that and create real human relationships as much as you can, because at the end of the day, you know, any political environment is going to be run by people. And the more, you know, as Peter said, build human capital, or, you know, the way that I would put it is just like, you know, make as many friends as you can, basically, you know, within your organization and elsewhere. You know, just be genuinely curious and excited about meeting new people and learning about who they are, what drove them to do what they do, you know, what they're passionate about, things like that. And the more, you know, positive relationships you can make, the better, you know, your outcome is going to be no matter what you do.
Yeah, and actually a major point there, like, again, I don't know the venture capital side at all, or private equity, but I assume this works across, you know, or, you know, an oil company or whatever. But really, I mean, like when I was at Wharton, they literally had a book called Dress for Success. I don't know if it's still out there.
It does still exist.
Everybody looked the same. I mean, and everybody tried to act the same. And I mean, I ended with a beard. I mean, I had, you know, back then it was
not cool.
No one. Now it's a lot more stylish.
Computer engineers probably had beards.
Yeah. No, it's crazy. So be yourself. Really, I mean,
yeah.
You know, everybody's so worried about fitting in. Just make sure, you know, an organization, I mean, obviously, you know, there's norms to be respected, but don't denigrate who you are. Okay. I mean, yeah. Be truthful to yourself and make it shine through. I mean, that's what's really you're going to be happier, you're going to do better work, and it's going to, you know, people will definitely just resonate with that as well.
And if you don't get hired because you're being yourself, you probably wouldn't have liked working there anyway. So it's always good to do that. Because it'll help you land the right spot too.
But I'm even talking about once you're there.
That definitely. But I mean, especially like in the interview process too, right? If you feel like you can't be yourself in the interview process, that's probably a good red flag that place is not going to be accepting of who you naturally are. And obviously, when you have to put in the energy to put up a facade, that's less energy that you're going to be putting into thinking about things that actually matter. So, I couldn't agree more with that.
And if you don't get your dream job, I mean, just just take something.
Yeah.
Like David Tepper, who I think you've probably heard of him, is you know, he's up there with Steve as being, you know, in the pantheon in terms of you know, great traders.
He owns the Carolina Panthers too.
Right. But he started out in Pittsburgh, working, you know, I think for Republic Steel.
I think he was raised in Pittsburgh. He grew up in Pittsburgh.
Yeah. And not a very glamorous job, but he made it work for him. You know, it's you know, everybody has this. I mean, I don't know if it's the same now, but it certainly was true then. There's certain glamour jobs that everybody's.
Yeah, it's still the same.
Okay, so I mean, everybody has their own path, and you can make things work at any level.
Yeah, definitely. Just go somewhere where you feel like you can learn.
Yeah,
that's all that matters at the end of the day.
Yeah.
Well,
And
thank
where
you
they're going to treat
guys.
you well.
All right.
No, I just said, and where they're going to treat you well, because that's obviously incredibly important as well, and respect you. Yeah.
Absolutely. Absolutely. So I know we have so many questions that we want to ask you guys, but I know that our time is running out. So instead, what we want to do is we want to open it up to the audience for any other questions that they might have about the Pave Finance app,
Sure.
anything about, today's market. So please, anybody who's curious and wants to ask any questions, please turn on your mic, turn on your camera. We'd love to hear from you. Okay. Nobody? Anybody? Any questions?
If your
No.
mic's not working, you can also send them in the chat. I'm happy to respond to any verbal questions, or I mean, not verbal, written questions.
Yeah. All right. So it seems like we have a little bit of a quiet crowd, but what we'll just kind of finish up with our question that we were really curious about.
Sure.
And
Yeah.
it's for Pascal, actually. So we know that you studied at Stanford. You studied something very unique, which was human computer interaction with design theory.
Yeah.
And we're actually very curious as to how your experience kind of melds into the business model and how your
Yeah.
business model works. And again, how
Sure.
that separates you guys from your competitors. Yeah.
Sure. Yeah. So I mean, I'll talk about that second part, but first, before that, I kind of want to start with just like what my major was and why I chose it. So I, going into college was very unsure about what I wanted to study. I loved environmental science in high school. I was, Stanford has this major called Earth Systems, which is basically environmental science. I thought I was going to study that. And I got to Stanford. I took kind of the introductory environmental science class and like kept on, pouring over the major requirements, and it just like something wasn't clicking. And I was like, this is what I really thought I wanted to do, but I don't actually want to do it. And there's a quote that kind of stands out. I forget who said it, but I'm pretty sure it was probably written somewhere and then repeated in like numerous commencement speeches. But it was basically like, write kind of the story of like the forward-looking story of your life in pen or in pencil, not pen, so you can erase things and change things. Basically, like be moldable, be changeable. And so, yeah, I basically was like, even though I was like dead set on studying environmental science, kind of just listened to myself and was like, nah, I'm not going to do that. And then, so I started studying what Stanford calls management science and engineering, did that for about 5 quarters. That's basically our like undergrad business major, but that also like wasn't fully sitting right with me either. And I took my first product design class through the Stanford D School and I fell in love with it. And so that was like halfway through my sophomore year. And I was like, okay, well, like now I really want to study product design. But the thing with the product design major, it was a bunch of design theory classes and then a bunch of mechanical engineering. And I wasn't really super interested in the mechanical engineering, but I'd taken a bunch of computer science classes and I really liked those as well. So I found out that there was a way to create your own major within the School of Engineering, and basically just applied for my own major that combined the design theory aspect of the product design major with the kind of computer science aspect of the computer science major. And found major advisors within both degree programs, wrote up my whole like 8-page statement and like, all my class requirements and everything. It was kind of a painful process, but very, 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 very worth it. And yeah, I basically at that point just kind of, my junior and senior year was largely working on finishing up my major requirements and studying kind of exactly what I wanted to do, because it was basically out of a time necessity thing, right? It was like, there's all these classes I want to take, but I also need to graduate with a major. So like, how do I do that? And the designing my own major was the way that I found to do that. But yeah, so kind of during, that time, right. And having the exposure to both, design thinking and design theory and UI UX design, and as well as kind of, a broad-based computer science education, understanding how tech tools are built and how algorithms work and all of that, how systems run, how web applications run. I was able to position myself well for kind of product management work, which I did, during the school year with startups, during internships, things of that sort. And that was a really awesome job where I was basically able to kind of combine business analytics, design, engineering, and business strategy as well. And that, was an awesome experience. I was considering going into that after college, as I mentioned, chose not to and chose to go into consulting instead, because I really wanted to focus on that business strategy skill set rather than, I think product management can be a tough thing to go into full-time after college, because you're not only learning how to be, a functioning member of the workforce and be organized and, navigate a large political environment, but then on top of that, you have the design, the engineering, the business skill sets to develop. So I thought I was basically just going to be spreading myself too thin and not learning enough in any kind of one area. So I chose to go to McKinsey, and I think it was the right decision because I really honed in on kind of the business strategy, communication, and human relationship aspect of things. But yeah, I mean, now as kind of a person who's with Peter running a consumer-facing tech company, it's pretty important to be able to understand how to build an application, how to put together a user interface, how to test that with people, how to properly get user feedback, how to also just understand, interview people in general, understand kind of what their core needs are and build for those things, right? Before you even start with anything, and then tweak as you go along. And I think just having experience in that and having kind of the educational background to be able to do that pretty well, at least I think pretty well, has been incredibly beneficial, especially early stage in the company where, it's basically just the two of us and there aren't too many people to be, throwing their hands at the problem. So, the more that obviously starting a company that you can handle yourself and handle with a degree of skill yourself, the better.
So that just about is the end of our questions for Pascal and Peter. And thank you so much for giving us that answer. It gives us a really great insight into also the human aspect of Pave. You guys really have the mathematics, the models down, but we also have the soft skills, the people side of Pave, where you guys really understand your consumer and you want to do right by them. So we are so excited to see the rest of your journey. Oh, I think Nathan Black actually has a question. And it's about inflation and the spike coming. So do we have just about 2 minutes to answer this question, Peter?
Yeah, I think we're probably okay to go. A couple minutes over.
Okay, so the question is, what is the inflation outlook? Do you guys see a spike coming this summer? I know the Fed has reiterated that they're not overly concerned about inflation, but the market seems very focused on near-term inflation, especially bond investors that you had mentioned. So if we could just very quickly go over that question.
I'll try to answer as quickly as possible, as succinctly as possible. Powell has to say that because despite overwhelming evidence that inflation is going higher, looking across the asset market, the commodity markets, inflation expectations, there's something called inflation break-evens. There should be a spike coming. The only way that we're not going to see inflation expectations really get embedded and wage inflation also rising is if rates go so high, interest rates go so high, so the market gets ahead of inflation and the 10-year goes above 2.5%, you'll see an impact on mortgages and real estate. And if that happens, you could create, along with higher oil prices, even higher oil prices, you could create a growth recession at that point, in which case rates will go down. For the other side of the argument that rates could actually go negative, you might want to check out Guggenheim has this guy called Scott Minerd. He's talking about negative interest rates. But that would be the dynamic that could create that. I think we're entering, just in terms of demographics as well, there's a number of different ways you can look at this as to why we should get inflation coming. And the cyclicality of it also has to do with demographics. And if you look at a 5-year averaged workforce, the entrance into terms of the workforce, and you move it ahead 5 years, we're right at the cusp of up from a demographic standpoint. So we'll have to see how that plays out too. But yeah, I do see it coming. I don't see, the only way it's avoidable is the negative aspect, that the markets get ahead of it, and the Fed isn't able to do yield curve control. This is like a 20-minute discussion that we can have, but they're reluctant to do yield curve control because they don't know when they're going to be able to extract themselves from it if they start buying the 10-year to keep yields down. So I think the market has always led the Fed, and I think we're going to see that. It's going to create a lot of problems, especially with a lot of quant funds too, because they've trained their data on a deflationary deflationary period, no matter how far you go back, even if they go back 40 years. So we're going to be entering into a period where the implications for inflation will really have major effects in terms of the way assets work as well. Again, bonds and stocks will start moving up and down together where they hadn't before. And we'll just see The big thing is, though, is inflation expectations. If that really starts to get embedded, there's nothing the Fed can do. That'll be more long lasting.
Well, thank you guys for answering that last minute question. I know Nathan is super ecstatic about that. So again, thank you guys, both Peter and Pascal Corey, for answering our questions about your amazing new app. I know that I and Anshul and a bunch of Fordham students will be the first to get our hands on it when it's ready to be for market. And we just are so grateful that we learned so much about the markets, about your experience, about the app, about what goes on behind the scenes. And I know that you guys are just headed for future success with this. And I know that you guys are going to help so many people with their investments. So thank you guys so much for joining us
just
today.
one final plug if I can, where our wait list is currently live. So if you want to go, sorry, my bad. If you want to go to our website, pavefinance.com, and sign up for the wait list, that'll keep you up to date on all of our updates. And then we'll give you priority access to the beta once we have something to provide. So once again, that's pavefinance.com. And it's non-binding, it's free. So go ahead and sign up if you like.
Thank you guys so much.
Thank you very much. Thanks.
Yep. And everyone have a great, wonderful Monday. So yes.
All right.
Thank you all so much.
Yeah, appreciate
Thank
it.
you.
Bye.
Thank you. Thank you.
Thank you so much, everyone.
Of course.
Take care.
Bye.